Alright, so now let's switch gears a little bit to notes receivable. So what's the difference between an accounts receivable and a notes receivable? Well, there could be essentially two possible differences here. A note receivable could either be a loan, right? We loan some money to another entity, or it can be either a conversion or a large sale of our day-to-day sales, right? And it's just going to take them a little longer to pay off. So we may have a client who comes in. Clients may typically buy one or two items off of us, or one or two services, and then this client comes in and they want 10, but they don't have the cash right now, so they sign a note. So a note's going to be longer term, and it's going to have interest, explicit interest associated with it. Okay, so we're going to have to make several entries related to this note. We're going to usually have to make an originating entry, and we're going to have to make adjusting entries, and then collection entries, right? And depending on how long the note is, there could be several adjusting and maybe more than one or two collecting entries, depending on how the note is structured. So as a real quick way to look at this, let's assume that on November 1st, we sell a large quantity of items to a customer for $10,000 and agree to a 6-month note receivable with an interest rate of 12%. So let's just stop and think about economically what's happening here. We've made this sale. We've provided the product to the client. They gave us a formal contract, or they signed a formal contract that says we will pay you $10,000 plus interest at a rate of 12% in 6 months. Okay, so we got a half of a year of a note. Remember that 12% is an annual rate. Okay, so first let's record the origination of it. And since this one was related to a sale, we're going to have a debit note receivable of 10 grand, and we're going to credit revenue of 10 grand. Now, this credit could also be cash if it were a loan. It could be accounts receivable if a client is experiencing cash flow problems and they say, hey, we're not going to be able to pay you in 30 days. Can we convert this to a note and let us pay it over time, right? So there's 2 or 3 different ways we could credit here, right? But the debit's going to be a note receivable. Since this note was issued on November 1st and it's going to be 6 months, December 31st is going to happen in between there, so we're going to need to create an adjusting entry related to this. Okay? And let's think, how much interest will we earn this year? Well, we have 10 grand, we have 12%, and we have 2 of the 12 months, right? So 10,000 times 12% is $1,200. Times 2 divided by 12 is $200. So we should be recognizing interest receivable of $200. Remember, we weren't paid. And crediting that interest revenue for $200. Okay? So we have origination and we have adjusting. Now let's collect if everything goes as planned, right? On the collection, they're going to pay us the note, the $10,000, plus the interest that they owe us. And the $10,000 times 12%, the note was outstanding for 6 years or 6 months, so 6 over 12. They owe us a total of $10,600. Of that, we had already booked $200, right? That was interest revenue on the last income statement. So the receivable stayed on our balance sheet. Now we get to take it off. We're going to recognize the remaining 4 months of interest revenue that actually happened this period. And we're going to get rid of the note. Right? So they don't owe us anymore. We're not expecting to collect anything else. All right. Sales are great. But unless we convert them to cash, they're useless. All right, cash is going to be the ultimate. This is the only thing that matters. So the only way that we're going to be able to operate is to convert those accounts receivables to cash. And now every industry is different. with the airline industry, or I'm building airplanes, not airline industry, so Boeing, whoever it is, the European competitor, whatever, right? Their industry, they're going to have a much slower cash conversion process because the numbers are so large and they're usually loans, right? Than, say, ConAgra, Hormel, Tyson, right? The stuff that we've been looking at this semester. So you want to keep in mind that you want to compare within the same general industry, right, when you're doing this. So the first ratio we'll look at is the receivables turnover ratio. And that is net credit sales, right, after returns, discounts, and allowances, divided by average accounts receivables. Now, how do we get average accounts receivables? The easiest way is to take beginning period accounts receivables, add ending period accounts receivables, divide by 2. Okay, that's essentially a quick and dirty way to do average accounts receivables. This tells us how many times during the year we essentially collect our receivables. Right, so whether it's 4 times a year or 24 times a year, right? This gives us an idea of how fast we're taking the sale and converting it. Now, if we look at the average collection period, the next ratio, that just takes the receivable turnover ratio and converts it to days. So you take 365 days, the days in a year, divide it by your receivables turnover ratio, and that gives you your average collection period. So it's sort of accounts receivables days outstanding, right? So if we're looking at 20 times a year we turn our receivables over, then hey, our receivables stay on the books about 18 days. Not bad, right? We're collecting 18 days. We're collecting our accounts receivables. That's not very long from sale to collection, right? That seems like a good business model to me. Now, the reason we do these two things is when it gets into forecasting. If we want to see what it looks like, so let's say sales increase by 5%, right? And assuming a constant receivables turnover, right? No change in the credit quality of our customers, we'll get an idea of how fast and how much cash we're going to have, how quickly that cash will build up to do other things, right? So that gives us an idea when we talk about forecasting and trying to figure out what cash flows are going to be in the future. These guys start helping us. Now, the last thing I want you to do, I've posted Tyson on the Blackboard account. Take a look at ConAgra and Tyson, and let's see if we can calculate receivables turnover and average collection period for the two to sort of compare what do their receivables look like. They're about the same size, so we're going to see, are they about the same on receivables turnover and average collection period.